a drop in the market might restrict the growth of new funds, but as far as the economics of the old funds, they've got, a long runway to go. They'll be collecting fees for the next decade.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. Today, I want to remind you that there is a website associated with this podcast called wealthformula.com. And I should also point out that there is a group that is opened up now. It's called Wealth Formula Network, and that is the mastermind of Wealth Formula Podcast. There was a course once upon a time. There is a course, actually. There still exists, but now I give it for free. It used to be sold for $2,000. That is available at wealthformularoadmap.com. But that's also where you can sign up for Wealth Formula Network. The idea is that you watch the course and then you get on the mastermind calls and basically discuss some of your own personal financial issues and sort of get the feedback from other members as well. In the past, this has been a very, very popular thing, and we're opening it up to a new cohort. So check it out at wealthformularoadmap.com. That group is a subscription-based, and I'm giving away a month free just so you can try it out and see if it's worth your time. And you can cancel at any time. Anyway, again, check that out, wealthformularoadmap.com. Now, as far as today, what I wanted to do is, again, we're just trying to cover all these different kinds of topics in investing with you, try to explore them. When it comes to wealth building, there is certainly an allure of exotic investment products that can be hard to resist. And I am certainly one of those people. I get very interested in these sort of alternative things, for better or for worse. And in some cases, it's been very good for me. In some cases, it has been very bad. So, from cryptocurrencies to rare collectibles, there's a lot of excitement. There's exclusivity. There's a potential for big returns. But, what are some of these things and what's the reality behind them? Well, we talk about cryptocurrency a lot. We've been talking about that, especially since Bitcoin has seemed to have gone truly mainstream at this point. And so we know that the upside is real. Early adopters in particular, I mean, those guys, some of them made billions of dollars. It's crazy, right? So there's clearly an upside to this. And even people who in 2017, like when I started really talking about it on this show, people who bought cryptocurrency and Bitcoin back then, when they first heard about it from me, made a ton of money. Like in some cases, we're talking about like 8 figures, 9 figures. But the thing with cryptocurrencies you're seeing right now, if you're just gotten into, the volatility is intense, right? Prices can crash as fast as they soar. So there's risks to it, right? There's a lot of risk, especially in volatility. I tend to think of, Bitcoin different from the rest of the cryptocurrency market. I tend to think of Bitcoin personally as something that is, I don't think it's is truly as a risky asset as the rest of cryptocurrency anymore. So, by the way, I should point out, when I look at the number at the price of Bitcoin today, which is about $80,000, all I can think is, and I'm not super liquid right now, just because I've said before, I'm a real estate guy, and real estate's been slow. And on top of that, it's just real estate guys never have liquidity, right? But I'm not super liquid, but if I was, I would be pouncing on Bitcoin right now. I mean, it sounds crazy. Bitcoin at 80,000, but gosh, it was up to, just a month ago was almost at 110. And so if you think about it there, you think about like the adoption that's continuing to occur, and you have an administration that's so bullish on this stuff. Do you not think it's going to at least get to 110 again? Right. So to me, it's like built-in equity at this point. So I don't know, just something to think about. Another thing to think about, which I haven't really gotten into really, is rare collectibles, right? Passion meets profit. Investing in art, fine wine, vintage cars. I would do the vintage car thing, but I'd choose the wrong art. I'd probably drink the wine, so that wouldn't help me at all. Anyway, well-chosen piece, it could make a lot of money. So for enthusiasts, there's an emotional reward as well. On the flip side, these markets, again, are liquid. You got to store them. You got to protect them. You might have to buy insurance. Unlike real estate, which might generate some rental income or stocks and dividends, collectibles, you don't have that. So there's a cost. You got to hold on to them. What about private notes? Okay. There's high yields there. So a lot of people have noted in this last year or two, there's a lot of risk there too, right? Private notes basically involve lending money directly to individuals or businesses, often real estate developers or small companies, in exchange for interest payments, typically, yields above, again, traditional bonds and savings accounts. It's a chance to earn solid returns, maybe 10, 12% or more. However, as we've seen, defaults can spike during economic downturns or times like now where these interest rates went completely, haywire. And then again, your money's locked up until the note matures. So if you need your money, you don't have it. But again, that's real estate, right? Bottom line. You don't get the tax benefits on notes either. There's no depreciation and all that. So the last thing you want to talk about, or at least address, is private equity. So private equity, it's got this sort of fanciness to it, right? It comes with sort of the ultimate exotic investment, especially for the wealthy. And it's frequently billed as a special opportunity reserved for the elite, where, funds pool big money to buy, revamp, and sell companies for hefty profits. The perception is that private equity is a gold mine, right? But is it really? Is it really that big of a difference between, the stuff that we can invest in or that anyone else can invest in? This week's guest on Wealth Formula Podcast argues that private equity might not be the golden ticket it's cracked up to be. He actually wrote a book on it, and we're going to talk to him right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you've borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Jeffrey C. Hook. Jeffrey is a senior lecturer in finance at Johns Hopkins Carey Business School, has decades of experience as an investment banker and a private investment executive at major firms. He's the author of The Myth of Private Equity, an inside look at Wall Street's transformative investments. He's also written a book called M&A, A Practical Guide to Doing the Deal, and also Security Analysis on Wall Street, a comprehensive guide to today's valuation methods. Jeffrey, thanks for joining me.
My pleasure. Nice to be here.
So you and I just talked offline. A lot of what my listeners are hearing and a lot of what our group is involved with is in alternative assets, but, mostly real estate. And so I like the idea of kind of helping people understand, what this whole private equity thing is, because it's like this shadowy world of the quote unquote super rich, right? And for us lowly doctors and business owners and other kinds of professionals, what is it really? And how does it work, that makes this thing so sexy?
So during my career, as you pointed out, I've done many private equity deals and private credit deals. So essentially, private equity is a big investment fund, a big pool of money that aggregates money from lots of different investors, which in this case is usually institutions like endowments or large state pension plans, because most individuals don't qualify for investing in private equity. The rules are being loosened, but right now it's not an investment choice that's available to a lot of your listeners because of their net worth requirements and some of the other restrictions that the government imposes, but is starting to loosen up. But essentially, you're buying stock in a private company. So the companies that are in private equity resemble a lot of the companies that trade in the stock market. They could be supermarkets, they could be oil companies, it could be car parts manufacturers, except they're not listed. So the private equity funds are buying these private securities. They usually buy control of the company so they can influence how they operate. And if you're a private equity fund that buys into these private companies, one of the real concerns is that you're illiquid. You and the other investors are illiquid. That means it's hard to sell an interest in a private company or an interest in a private equity fund. But the underlying economics of a lot of these companies are quite similar to publicly traded firms.
So, but a lot of them have various strategies too, right? Like, for example, they might do roll-ups. They might try to buy a bunch of smaller companies in the same area and then try to maximize the scale and sell at higher multiples. I mean, isn't that a lot of what goes on in this space?
Yeah, well, that's a very popular topic strategy in the leveraged buyout space. So your listeners ought to know there's three basic forms of private equity. There's a leveraged buyout, which I think we all know about, where you borrow a lot of money to buy the company, and then you're sort of taking a crapshoot that it can pay it back. So that's the leverage buyout. That's about 2/3 of the business. And the roll-up or consolidation strategy mentioned is probably one of the most popular growth tactics in leverage buyouts. The other one would be venture capital. I think everybody knows what that is. Mostly high-tech, young companies. And then there's something called growth capital, which is a little in between. So you got three major categories. And, within each category, there may be differences in style, as you alluded to. Some may be roll-up strategies. Other may be geographical preferences like the United States or Europe. And some are industry preferences, such as consumer products or energy or software or something like that. So they're slice and dice it, many, many ways. To pick the right fund, of course, you got to do your homework, almost like picking the right kind of stock.
Yeah. As we talked about at the beginning, private equity sounds like this, haven for the rich, some sort of golden ticket, big returns, that kind of thing. You say it's a myth. What's the biggest misconception our listeners have maybe heard about PE? And I guess, what's the reality?
Well, the province of private equity is for institutions like state pension plans or university endowments like Harvard or Yale. So a lot of your listeners as private individuals cannot subscribe to it directly because they don't have enough money or because they're not qualified by various federal and state regulations, which I said are being loosened. But, over the years, an aura has developed around private equity that it outperforms the stock market by many times, and that these people that run the funds are geniuses. So, there was some element of truth to that maybe 25 years ago when the business was a lot smaller, when it was a niche business. But now it's kind of widespread. Every state pension plan, every university endowment, every foundation owns a chunk of these private equity funds. The competition for deals has gotten quite intense, and the returns have dropped commensurate with the competition. So, unfortunately for the investors, these big institutions, private equity, last 2 years has underperformed the stock market. And there's nothing more dramatic than, say, looking at 2024. And one of the big investors is the state pension plan of California, which a lot of other state pension plans copy. So their private equity portfolio was up, maybe up 6 or 7% according to their statistics, and their stocks were up 20. So you had a 13-point difference, which is, a yawning gap between the two investment categories.
So is private equity always have the goal of basically, this sounds like a silly question, I know, but you'll see where I'm going with it. Is the goal of private equity companies always to outperform the market? In some situations, obviously, and maybe this is just not considered private equity, but, there are situations where, ultra high net worth people invest money because they don't want to lose money. And so they are, trying to get into things that maybe will provide a stable return that may not beat the market, but frequently will not lose. Are there strategies like that within private equity that you can kind of blame this on, or is this just outright, lack of performance and big risks and still no return?
No, there are no that's called a market neutral fund. You
Uh-huh.
see that term in hedge funds a lot. Hedge funds, of course, invest in publicly traded securities and derivatives, but private equity, everything is market oriented. So you don't have any market neutral
Got it.
funds as you just described.
Another question you brought up a couple times that, most for, that our listeners are not typically qualified. I mean, I actually know because we do have generally higher net worth individuals on here. So are these for, typically, are there opportunities for accredited investors? Or are you saying you have to be like a buyer? What is that? A qualified buyer?
Well, you'd have to be more in the former category, an accredited investor, which, as I recall, it's a $2 million liquid net worth,
Yeah.
which would be a net worth outside of your home.
Yeah. That makes up about 80% of this group. So,
Well, then a lot of your listeners would qualify, but then they wouldn't really qualify as to the minimum that you have to put directly into a fund, which would,
mhm.
often is several $1,000,000. So,
Yeah, right.
possibly some of your investors have talked to advisors or packagers, and they might go into a fund of funds, which might take a couple $100,000 piece. The problem with that,
Yeah.
such a small amount is that you've got fees on top of fees.
Yeah.
So you got
Yeah.
the advisor fee.
Mhm.
You might have the fund of fund fees, and then you got the fee of the underlying private equity fund itself. The fees on the private equity fund itself are usually 2 or 3% of the assets per year. If you add on a couple other fees that we've talked about, you're looking at 5% a year. So if you're paying 5% a year in fees, it's virtually impossible to beat like a stock market index fund where you're
Yeah.
paying, almost nothing in fees. It's just
Yeah.
impossible. Anybody can do the math.
Yeah, sure. That makes sense. I guess even at that, institutional level, it's typically like a 2% management fee with a 20% carry. Is that
Yeah,
typical?
that's totally accurate.
Yeah.
So even the institutions are paying 2 or 3% a year. So
And that's a year, right? I mean, that's
every
yeah, because
year. So if you
yeah,
invest, let's say an institution like the state of Illinois invests 100 million for their pensioners in one of these funds, and every year they're getting, 2 or 3% taken away. So the first year, it's 98 million that they're investing really, and then 96 and so on. So it's a little hard, they're fighting uphill battle to beat the stock market because, the fees are so much lower in the stock market. Not to say that some of them don't, about, I don't know, maybe a third of them beat the stock market. The rest either are flat or below the stock market, which is sort of a little known fact that the business media and the marketing machine of private equity don't want you to hear.
yeah, yeah, for sure. What you'd mentioned too with regard to leverage buyouts, loads companies with debt, they end up bust sometimes. What's breaking there? Is there an element of sort of the investments that you make or these guys are making? They're just bad picks. They might be investing in things that are sort of heads, I win, tails you lose type situations. I mean, what's the story behind that?
Well, look, got a sort of a template that they all like to play with. I mean, so if you read your book or you listen to some of your stuff, you sort of got a template as to what kind of real estate seem appropriate when you do your syndications. You have to pick a certain kind of profile for whatever multifamily units you're trying to syndicate and sell to investors. Well, the PE funds are not that much different. So, LBO funds, leverage buyout funds, have a certain template. They want a company that's low tech because that way the earnings won't vary too much with the times. They want something that's been around or established for many years and has a pretty stable client base. So that is the profile that's 80% of leverage buyouts. Venture capital and growth, the profile will be a little different. So that's their mindset. They run out and look for those kinds of companies. And the people that are running these funds, they're all pretty smart, so they all got Harvard or Wharton MBAs or Ivy League educations and all that. But, they're all competing for the same product. And so, as I said a little earlier, they're running up prices. And as a result, the returns are going to drop, much like you'd see in so probably some branches of real estate, which you have experience in, Buck, where, if everybody's piling into data center real estate or medical office property real estate and the prices go up, the expected returns are going to fall a little bit.
Some of these PE firms are probably killing it on a regular basis, right? Or is there really no? I'm just curious on that. Like, I mean, a lot of them are flopping, a lot of them are not beating the market, but are there some out there that we know of that like constantly seem to do pretty well?
And funny, I'm not sure a lot of your readers don't read these academic type journals, and I just had an article published about that very thing where I looked at the top 25 LBO funds, and most of these big fund managers like Carlyle or Blackstone run multiple funds. So I looked at the funds which were somewhat mature. You can't really look at the young ones because they
Yeah.
haven't had time to develop a track record. I looked at the mature ones, and there's a wide divergence of performance among the various families. And I'd say the ones that were most successful that tended to beat the stock market were the few funds that sort of had a high tech orientation, like Francisco Partners, for example. And it's not high tech like AI where there's no track record or anything, but it might be software companies that have been around for a while. So you might say, well, that's low tech, high tech, and you're probably right. But it would be an emphasis on companies that work in the high tech space, whether they're making kind of equipment or software, and those have tended to perform the best. The ones that do the old nuts and bolts or metal bangers, that they tend not to do so well. And I was surprised at how there was a divergence among the funds, but a lot of the more conventional ones, they barely beat the stock market, or they did not. And some that are more high tech oriented would beat the stock market by a decent margin. Wouldn't double it, but might be stock market plus say 30% over 10 years. That's a long time, 10 years to wait. But
Yeah, and they're not consistently winning.
no,
Yeah.
you'd be surprised. They could be kind of inconsistent from fund to fund. And the historical track record of a fund manager, if they're running 5 funds or 10 funds, some of them run more than that, there doesn't seem to be much correlation or persistence from one fund to the other. So, it could, as you know, from being in the markets a lot, how do you look at the possible performance of fund number 5, which is new? You usually look at fund number 4.
Right.
How did that do? Or fund number 3. And you say, well, 3 and 4 did okay. I guess 5 will be fine. But often there's no correlation between what 3 and 4 did and what 5 did. So, picking a fund that's going to be successful is almost like throwing darts at a dartboard.
I'm curious in terms of like some of the research that you did, because these private equity firms are kind of traditionally, they're pretty opaque, right? So it's hard to see what's really happening inside. So how do you actually do that? How do you get some of this information?
Yeah, being secret and saying, everybody's a genius and we only go to the big institutions or rich people is part of the mystique. But you can get information on the historical results. You just have to go to a private equity data service. The problem with those is they cost about $20,000 a year. So your average person is not going to want to pay $20,000 to look at the results of the last 5 LBO funds by Apollo or the last 5 venture capital funds by some big venture capital company. It's just too expensive. You don't want to do the due diligence. And, if you're working with a financial advisor who's going to plant you in some of these funds or fund of funds, it's unlikely that the financial advisor is paying $20,000 a year to look things up. And even if you did look it up, there's no persistence. As I said, there's no consistency from one fund to the next. But I guess most people would say, well, at least I want to look at how they did in the past. And that's probably not a bad way to start. But let's face it, how many people are going to pay $20,000? If you talk to the New York Times or the Wall Street Journal, they don't subscribe to these private equity databases either. It's too expensive.
Well, on the other hand, though, you've got these huge, pension funds, California. I mean, how are they getting duped? I mean, how are they, why is it that it's not like they just started investing in private equity? If they haven't been seeing the results, why would they continue putting, hundreds of millions of dollars in this stuff?
That is a question I get a lot. And, I have a few reasons I outline in the book, but I think the main reason the institutions keep doing it is because of what's called a principal agency problem, where the agents, i.e., that is the investment consultants and the staff of the funds themselves, need some justification for their own existence. So even though, it's been statistically proven that most, I don't know, 99% of all pension plans, 99% of all university endowments don't beat a simple Vanguard 60/40 index, the Vanguard blended fund, which is one of the biggest index funds in the world. None of them beat that on a consistent basis. In fact, they're about 1 percentage point behind. You'd say,
What
why
was that?
don't they?
What was that Vanguard? What was that Vanguard fund? People might want to know
It's a
about that.
Vanguard blended fund. It's, got 500 billion in assets or something, but it's a 60% stocks and 40% bonds. So that's a sort of a traditional gold standard mix.
Yeah.
But
Yeah.
the staffs of the funds of the pension plans don't want to do that, because then the board of trustees can look at it and say, if I'm going to index with a computer, what do I need you guys for?
Yeah, 100%. So you've got these people who are making presumably a lot of money that are been hired to pick winners, and they want to feel useful and at least pretend that they're doing something that might be making the fund more money.
Yeah, that's exactly the case. And so if you look at, say the head of the Duke University endowment could make several $1 million a year. He might make even more than the president of the university.
Yeah.
And that, even though Duke's endowment would underperform a simple index fund, no one seems to pay much attention, in part because if you look at a state pension plan, for example, the board of trustees, who's on the board of trustees? There'd be a few political appointees. There'd be maybe the state treasurer, and there'd be, several of the union leaders for the police and the teachers and the firemen and so on. And, out of 12 board trustees, maybe one has ever worked on Wall Street. And so they get hoodwinked pretty much by their staff, so the consultants. And as we just talked about, those latter two parties are more interested in pushing a complex structure, tends to, as you said, preserve their jobs that are sometimes quite high paying. It's a little cynical view of the world, but that's the way it goes.
You would think at a place with a lot of smart people like Duke that they would figure that out.
No, they haven't, and it's been, years and years. So they all kind of imitate, but they all kind of
Yale,
imitate,
they all want to be Yale.
The Yale model.
Yeah. So Yale, so tell us, some people may not know what we're talking about. Tell us about that.
Okay, so a lot of what we've discussed going into alternatives like hedge funds and private equity funds, and to some degree real estate and commodities, which are two categories I know you think are, and I think they're pretty good as well, having, invested in gold and real estate myself. But it all started maybe 35 years ago with Yale, when this guy on where I used to work as well, Lehman Brothers, he left Lehman Brothers. He had known some of the people at Yale, and they said, we want to take a fresh look at how we invest our endowment, which might have been $5 or $10 billion at the time. And so, you're looking at a fresh look by a fresh set of eyes. And he said, well, we're so conservative and we're so conventional. There's a lot of new things coming, real estate, buying real estate directly or through funds, buying private equity, which had a pretty good track record, looking at hedge funds instead of just buying vanilla stocks and bonds. And so he and a couple others were the first to dip their toes in the water. And they had a pretty good run. It lasted about 15 years where, the Yale and a couple others that were imitating Yale beat the others by several percentage points. You might say big deal, if they're earning 13% and everybody else is earning 10. But, if you got $10 billion and there's a 3% difference, that's $300 million a year. That's big money. And, it's all compounded, as you know, from Warren Buffett's preaching about the compound interest.
Right. So we're kind of in an unusual environment right now. In fact, you're a business professor, and we've got an economy that's kind of got people, I think, a little scared because of the way the administration, with tariffs and scaring the markets now. And you see, like, especially the tech markets, the quote unquote risk off type investments kind of suffering. Does that affect private equity? How does that kind of environment bode for private equity?
private equity being a little bit of a higher risk category, it's going to back off a little bit when the stock market falls in a consistent way. So, yeah, they would retard the growth of private equity. But you got to remember, a lot of these funds are 10 years long. So, any funds that have been raised in the last several years have got 8 or 9 years to run. So, a drop in the market might restrict the growth of new funds, but as far as the economics of the old funds, they've got, a long runway to go. They'll be collecting fees for the next decade.
Yeah. In general, again, with your perspective on having been in the private sector and all that right now, what do you think we're headed for in terms of with the economy as I described it?
Well, I think the economy was in excellent shape when Trump took office, and with his tariff policies, there may be a few bumps in the road. I just doubt that he can be consistent with keeping these tariffs high. I think it's sort of a negotiating chip to try to get a few concessions out of our trading partners, or to punish them for fentanyl or not supporting the Ukraine war or supporting the Korean war. So it's more of a transactional thing, even though I think, the bottom line, he does have some good points. Let's face it, the U.S. has been sort of the open market, whereas, I've traveled all over the world, and I can tell you so many markets are closed to American goods effectively. So, I mean, what could really damage the stock market in terms of pricing levels is if Chinese tries to put the squeeze on Apple, because Apple is probably 10, not 10, but maybe 6 or 7% of the stock market. It makes virtually all of its phones in China. And if they were to cut that off, you're going to see Apple stock drop from 220 to probably 80.
Is there any reason why they wouldn't do that at this point?
Well, the fact is that there's probably 1 million people in China, probably more, that are dependent on making Apple phones. So you cut them off, those people are suddenly unemployed, and there could be some civil unrest in China. I mean, civil unrest there is not as open as it is here. People have a chance of being punished if they protest or what have you. But, there always is that possibility the government has to weigh that against punishing Apple or the United States.
Yeah. Well, interesting conversation, Jeff, and I do appreciate your time today. The book, again, Myth of Private Equity, an inside look at Wall Street's transformative investments, presumably available anywhere, everywhere. And thank you again for being on the show.
Man, my pleasure, Buck. Nice talking with you.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you.
Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Just a reminder, once again, if you have not done so yet, take a trial run at joining Wealth Formula Network. Go to wealthformularoadmap.com, download our course for free. There's a lot of great information in there. And then join our conversation and give it a try. Subscription-based, first month's on me. If you don't like it, don't keep going. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.